Hi, Bill Lethman here from Lethman Financial. Welcome back to part 2 of our 4-part series on rethinking retirement income. In this video, I'm going to be walking you through a case study as we help you to complete your own set of retirement planning worksheets. So let me introduce you to John and Sally as they approach their retirement. They have a few goals that we want to keep in mind. Maintain their current lifestyle, don't run out of money, pass any money they don't spend in their lifetime on to their kids. They want to do this and still be able to sleep at night. So there's 5 basic financial organization steps that we're going to walk through in this video. Step 1, inventory your assets. Then add up all your income. Next, add up all your expenses. Calculate your cash flow surplus or deficit. And finally, determine your withdrawal rate. One of the greatest challenges facing investors is keeping track of all your financial information. As you become more successful, life doesn't get easier, it gets more complex. What we want to do here is bring all your financial information together in one place so we can see where it's all at. What you want to do is gather all your latest statements from all your different financial accounts and assets. I mean all of them. IRAs, 401ks, mortgage statements, insurance, health savings accounts, whatever you have. One easy way to do this is to get a box and put it near the area that you sort your mail. Anytime a statement comes in, just throw it in the box. Keep in mind that some of your statements come every month and some only come quarterly, so make sure you get all of them. Another thing you could do is go online and print your latest account information if you have online access. A general rule to follow is if it has anything to do with your finances, put it in the box. Okay, let's pull out your worksheets. Step 1 is to take an inventory of all your assets. You'll want to use the most current figures from all your accounts. If you have access to your accounts online, you can use those figures. If not, just take the balances from your most recent statement. At this point, we don't really need to be specific on how the money is invested. The most important thing you need to do here is to separate your retirement accounts from your non-retirement assets. It's also a good idea to break down your non-retirement accounts into liquid and non-liquid assets. Your liquid assets are your cash reserves and will be the first bucket of money that you tap into to meet your retirement income needs. I'll talk about that more in section 4. So we kept the numbers pretty simple here for John and Sally. They have some non-retirement liquid assets, some bank checking and savings accounts, a CD, and an account at a local credit union for a total of $200,000. They also have $100,000 in a mutual fund account, which we've listed in the non-retirement, non-liquid category. This brings their total non-retirement assets up to $300,000. Then they have some retirement assets. John has a 401k plan, Sally has a 403b, and they both have some IRA accounts. Altogether, their retirement accounts add up to another $700,000, which brings their total portfolio assets up to $1 million for John and Sally. Okay, let's look at some expenses. Now there's 2 basic types of expenses. Your basic expenses to cover all your essential living needs and desired or lifestyle expenses to cover all the extras. Let's look at John and Sally's basic expenses. These are essential expenses like mortgage payments, property taxes, utilities, food, and medical expenses. For John and Sally, these expenses total $65,880. Don't worry if your expenses are a little higher, a little lower. This is just an example. Next, we'll look at their lifestyle expenses. This is all the fun stuff like golf, going out to dinner, vacations, and entertainment. For John and Sally, this adds another $31,320 onto their total retirement expenses. But even though these are not essential expenses, we want to start our planning process with everything included. Then if we have to cut something, we can look at this report and see what expenses could be cut or reduced. Okay, now let's look at income. We want to get an idea of how much money you're going to have coming in on a regular basis in retirement. Here we want to just add up our fixed income sources like pensions, Social Security, annuity payments, and any rental income that you may be receiving. For now, we want to leave out any dividend or interest income that you might be getting from your portfolio assets. One last source of income that we want to include is employment income. You may retire from full-time employment, but maybe you'll work part-time or do some consulting on the side. Or maybe your spouse will work for a few years after you retire. So we want to include this as well. But we want to be mindful of when this income may stop and make sure that we have planned accordingly with our income plans. So here's John and Sally's retirement income statement. John has a pension, $32,750. He also has some Social Security for $19,234. And Sally also has Social Security for a total of $9,789. This gives them a retirement income total of $61,773. Okay, now let's start putting some of this together. Here's a recap of John and Sally's income and expenses. If we add their basic expenses and their desired expenses together, they need $97,200 a year, and their total income from fixed sources is $61,773. So if we subtract their expenses from their income, John and Sally have a spending deficit of $35,427. So in order for them to meet these expenses, they're going to need to pull some money from their retirement accounts every year. Let's see how this looks. What we want to do here is calculate their initial withdrawal rate. And to do that, we're simply going to divide their annual deficit by their total portfolio assets. So for John and Sally, their annual deficit is $35,427 divided by their total portfolio assets of $1 million brings their initial withdrawal rate to just over 3.5%. So is that good? Well, there's been a bunch of studies done over the last several years to try to answer this exact question. Most of them refer to what is called the 4% rule as the sustainable withdrawal rate that would give you a high probability of your money lasting for 30 years or more in retirement. In reality, it's actually lower than this. Probably the best research I've seen on the subject came from a book by Jim Otar called Unveiling the Retirement Myth. In it, he concluded that the actual sustainable withdrawal rate is more like 3.8%. Going back to 1900, a 3.8% withdrawal rate adjusted for inflation every year gave you a 90% chance that your money would last you for 30 years. That's with a portfolio that was 35% in stocks, 8% in money markets, and 57% in bonds. Stated differently, according to the Jim Otar study, if you had a $1 million portfolio, your initial withdrawal rate should be $38,000 or less. So according to this, John and Sally are okay. But we've left out one very crucial detail: taxes. If you're like most retirees, you probably have a significant amount of your retirement funds in IRAs, 401ks, and other tax-deferred accounts. So if John and Sally need $35,427 to meet their lifestyle needs, and they need to take it from a retirement account, the actual withdrawal will actually need to be larger to account for the taxes that they'll have to pay on the distribution. Here's how it works. Basically, you divide the amount of your retirement account withdrawal by 1 minus your tax rate. If John and Sally have a 30% combined state and federal marginal tax rate, in this case, we would divide $35,000 by 1 minus 0.3, which is 0.7, which means they would actually have to withdraw $50,610 from their retirement accounts in order to net them $35,427 after taxes. Now their withdrawal rate is up to 5%, well above the 3.8% sustainable withdrawal rate. In the last video, I talked about a number of factors that could cause your retirement to fail: inflation, taxes, market risk. Here, I want to add one more risk to that list. Most people don't really stop to consider how the premature death of your spouse can have an impact on your retirement income. Regardless of whether they were the primary earner for the family or not, you will lose some portion of your Social Security benefit, and if they were getting a pension based on their life, possibly a significant reduction in the pension benefit as well. So here I put up here again a recap of John and Sally's retirement income. If John were to die, Sally would be entitled to John's Social Security benefit, but she would lose her own benefit. Unfortunately, you cannot collect more than one. The same would be true if Sally passed away. John would keep his benefit, but he would lose Sally's. In either case, they would lose $9,789 of retirement income, basically what Sally was getting. Also, it's very common for pension benefits to have a 65% surviving spouse option. This means that if John dies, his pension would be reduced by 35% from $32,750 to $21,288. So the total retirement income would go from $61,773 to $40,521, a loss of $21,251. So if we apply our sustainable withdrawal rate formula, we can calculate the additional assets that would be needed to sustain an additional $21,251 of income every year. We just divide 21,251 by 0.038, our sustainable withdrawal rate, and we come up with $559,236. This means that you would have to have over $500,000 to safely generate the $21,000 you lost in income. Now, an argument could be made that it's not as costly for one person to live as it is for two, but most of the big expenses would still be there. House payments, utilities, and taxes would all be the same. You would, however, save in a few areas. Let's say that you save a little bit more than half and your income deficit just increased by $10,000. If we apply the same formula, you would still need $263,157 to sustain the additional $10,000 a year of income. So here's what we learned. We learned the 5 steps to financial organization: inventory your assets, add up all your income, add up all your expenses, calculate your cash flow surplus or deficit, and determine your withdrawal rate. We also learned that the sustainable withdrawal rate for a portfolio should be 3.8%. Any more than that, and you start running a serious risk of running out of money. We also learned about the impact that taxes and the loss of your spouse can have on your sustainable withdrawal rate. So that's it for part 2. I'll see you in the next video.